I believe that gold's market share in this market will at least revert to mean, which means that demand for gold should grow fourfold, which is what I believe is going to happen. I have no idea what that will do to the price, but I suspect it will be attractive. You and I have a mutual friend. I won't name him because of privacy. He's both an investor and a trader. He's a listener of yours, former client of mine, and he has gold in his portfolio, which is sort of permanent, but he also has trading gold. He bought gold back at sort of $1,500, thinking it was way underpriced and that it was going to go through $3,000. And I was talking to him the other day, and he said, "What should I do with that gold?" And I said, "Well, you bought it for a reason. You bought it because you thought the price would double. Now the price has doubled. For that portion of your gold, you should sell it. You're a trader." And so your response to gold depends on who you are, what reason that you bought it, and what position it plays in your portfolio. It's important to note that in the period 2000 to 2025, the gold price has gone from $250 an ounce to almost $3,500 an ounce. It's up 12-fold. When people ask me when gold's going to move, and you've asked me that, I've said it's going to move in 2000, which it's done. For me, I believe that the next 10 years is going to be very good for gold, but beliefs aren't worth much. Gold fulfills a place in my portfolio. It provides insurance against circumstances that we'll talk about later in this discussion. And it also provides liquidity. I consider gold to be good if volatile cash, but I realize that I'm different than many of our listeners. So your own listeners are going to need to develop their own framework for their own portfolio and where gold fits into it. This I can tell you, Steve, gold fits in every portfolio. The gold price is up 12-fold in 25 years, and ownership of gold in the US still constitutes less than 0.5% of total savings and investment assets in the United States, where the 4-decade mean is 2%. I believe that gold's market share in this market will at least revert to mean, which means that demand for gold should grow fourfold, which is what I believe is going to happen. I have no idea what that will do to the price, but I suspect it will be attractive. Well, I would argue a little bit about your first statement. I don't personally see an awful lot of qualitative difference between owning physical gold and the physical gold surrogates.
Okay.
I own both. I understand some people say if you can't touch it, you don't own it. I respect that. But I'm less concerned about how somebody owns physical gold. But I think you have to own physical gold. In my experience, you visualize a precious metals bull market like you visualize a circus master's whip. The front of the whip and the whip handle is the physical gold. It moves first. Afterwards, the very best gold stocks move, and they're just starting to move now. After that, the lower quality, the intermediate, the high quality junior producers move. Then the developers move, then the explorers move. That's the way it works. And you can follow that continuum, which has been proven in history successfully. I operate in all aspects of the continuum all at once, but that's just me. We're doing this upcoming boot camp because we see now that the probability that gold at least maintains its current price, but probably increases, means that the senior producers are going to enjoy greatly increased margins and free cash flow. And the market has begun to notice this and will continue to notice it. So we believe that we're in the part of the bull market where leadership changes from the bullion to the highest quality gold stocks. The upcoming boot camp this Saturday will deal with the very high quality gold stocks. Not just, although focused on, the biggest and best royalty and streaming companies and producers, but also the very, very, very high quality smaller companies that are likely either to move with this bull market or be taken over by other companies. The subsequent boot camp, 90 days from now, will encompass the rest of the gold miners. Uh, these companies traditionally move last, but they move fastest and they move the furthest. And so the first boot camp that we did about 90 days ago focused on the reasons why you own gold and how you own physical gold. Extremely well timed and a great boot camp. This boot camp will talk about the leadership change from physical gold to the highest quality gold stocks. Again, beautifully timed. Uh, and the last boot camp will talk about when the baton changes one more time from the highest quality gold companies to the rest of the gold companies. This is a fascinating chart. And I think it brings up a couple of points. The first is that your suggestion with regards to higher interest rates has a lot of validity. If you look at the fact that the Congress and the executive and the Fed are all trying to jawbone interest rates lower, and they're adding liquidity on the near end of the yield curve, but the long end of the yield curve is still moving up. That tells you that perhaps like the Clinton years, the bond vigilantes are taking control of the interest rate from the Fed, which is to say the Fed is losing control of the long part of the yield. If that happens, your suggestion with regards to the Fed funds rate is true. What would be fascinating, and I don't know how to do it, Steve, is to overlay on this chart not the CPI stated rate of inflation, but some sort of chart that maps the deterioration in the purchasing power of the US dollar relative to the interest rate. Because I suspect that the response you've seen in the gold price isn't merely interest rate sensitive, but rather is sensitive to the delta between the deterioration in the purchasing power of the US dollar and the US dollar return on capital employed in savings. If I'm correct, although the CPI says that the rate of deterioration of the dollar is 2.5% a year, when I look at the basket of goods and services that I buy, Steve, it occurs to me that the deterioration of the purchasing power of my savings relative to the goods and services I buy would suggest that the purchasing power of the US dollar is declining by 7.5 or 8% a year. And that's the rub. If the Fed funds rate, which is what determines deposit interest rates and the 10-year Treasury rate, is at 4.3%, and the deterioration of my purchasing power is at 7.5%, I'm losing 3% a year.
Yeah.
And what traditionally has moved the gold price, and I'm talking about for 1,000 years, is investors' perception that fiat currency denominated instruments are costing them real purchasing power. If I'm right, and we have a 300 or 350 basis point, 3 to 3.5% real difference between the deterioration of the purchasing power of the currency and the interest rate available on so-called risk-free savings, I think gold continues to do very well. And I think that your chart in that case is prophecy. John Williams at Shadow Stats has a different definition of inflation.
Yeah.
Perhaps you could average the Shadow Stats rate with the CPI and get a rate that's closer to the truth.
Okay.
The CPI, among other things, doesn't measure tax. And it's the largest cost of living for most Americans. The idea that you construct a cost of living index that doesn't include 35% of the economy seems very strange to me. But even if you leave tax out of it, if I look at the period, my memory is not as good as it used to be, Steve, but if I look at the period 2000 to 2025, and I look at what's happened to energy prices, gasoline prices, grocery prices, health insurance, health care, rent, mortgage interest. The idea that my purchasing power has been declining at 2.5% a year is silly. It's silly. And I'm an old, bald, fat, rich cheapskate. I don't spend much. If you compare me with the average listener that you have that has a life and has children and stuff like that, I suspect that I suspect that my estimates are conservative. And if we could construct a reasonably accurate, not a totally accurate, but a reasonably accurate statistic for the deterioration of the purchasing power of the US dollar, and then juxtapose that with a return on, and I probably personally wouldn't use the 10-year, the Fed funds rate. I'd probably use the 10-year Treasury rate because that's what's available to savers.
Okay.
It's the delta between those two
Yeah.
that drives the gold price.